I think a lot of people believe we found a bottom. I question it just because we don't have a very active transaction market. It's very muted on the transaction side. I do think we're probably closer to the bottom, although I wouldn't be surprised, depending on where rates settle over the next 6 to 12 months, that will be a big indicator. When I say rates, really the 10-year Treasury rate. I mean, the 10-year Treasury rates come down, below 4% today, but that's still double where we were pre-2022 when you look, over that decade where we averaged closer to 2%. So that's putting a lot of pressure on the underlying values of these assets, and that, potentially means values could potentially reset higher if the 10 years truly stays above 4%.
So in terms of that bottom, no matter who you talk to, whether they think that things have already bottomed out or if they're going to bottom out in 6 months or 12 months, one thing that everybody involved in commercial real estate seems to agree that this is going to take a long, long, long time to work out. Do you agree? And if you do, how long is it? Are we looking at a couple of years just scuttling along the bottom of, and why is everything so logjammed? When does it break up?
Yeah, so I'm a big believer that we're going to have it's been sluggish over the last couple of years. So starting, going back to the end of the first quarter of 2022 till now for commercial real estate, it's been a very sluggish period. And I think we're going to continue to have that, unfortunately, that sluggish period for commercial real estate over the next several years. And it's just going to take time as these loans are maturing, asset values continue to sort of, or really ownership groups have to recalibrate to where the new interest cost is. Mm-hmm. So it's just going to take time to get through this slug.
Well, that's what I'm really interested in, because let's just say we get 75 basis points of cuts this year, sure, right? As the swaps market are now pricing in. How immediately does that affect what you see?
Yeah, I personally, I think it doesn't really move the needle that much. I mean, I think it helps a little bit, but it doesn't really, it's not as impactful as you'd think. I mean, it obviously brings down debt service costs, floating rate debt, by, call it 15%, which is helpful, if it went down 75 bips, roughly about 15%. But your interest costs, if you think about pre-2022, you're still up, call it 17x, because you were next to zero, right? Like what people are paying off of SOFR, and now all of a sudden, you move down 75 bips, it's not going to be, probably as helpful.
So going a little bit more macro, I know that about 30% of your portfolio on the equity side, hotels, mid-level hotels, you own, I think, 90 of them or so, although some of that might be credit. Sean Hare of Trinity Investments joined us last week and also joined Alex and Paul, and he was saying for luxury hotels right now the growth is 8%, but for lower level hotels it's down 2%. Are you seeing this, and what does it say about the consumer? Because we continue to see this bifurcation on the consumer between the high end and the low end. Are you seeing that relative to your hotels?
Yeah, I think without question, I think consumers that are on the lower end side obviously are impacted by inflation, higher debt expense. The luxury segment hasn't been as impacted, and that's because that consumer has held up much better this time around. I do believe when you look at our portfolio, we're in the mid segment, and so we have a lot of select service hotels that are like Marriott, Hilton branded assets, and those hotels are continuing to have positive RevPAR growth. So we're up about 3% year to date, but you're definitely seeing occupancy slow down. RevPAR is...
I know. Okay. Revenue per available room.
That's right.
I was going to show off to Alex and Abigail. Just real quickly, if you were to go buy a piece of commercial real estate, an office park in suburban Atlanta, what kind of discount do you think you'd get off of the pre-pandemic valuation?
It really depends on the asset.
Because it's only 70% out. I've seen this property 1,000 times in 1,000 towns. It's 70% occupied. It's parking lots half empty, all that kind of stuff.
I mean, if it's going to trade, you're getting like 50% discounts.
Wow.
Is my just high level number without going through the nuances, and potentially you're even seeing larger discounts for some of these assets to trade. I mean, there's one big asset in Buckhead, Atlanta right now that's coming to market. Or at least the debt's coming out to market, and it's going to trade at a pretty substantial discount to where it was pre-pandemic.
And Buckhead's still Buckhead.
Buckhead's still Buckhead, yeah.